Good morning and welcome to our continuing series of Wednesday morning panel discussions for entrepreneurs, innovators, and investors. I'm Brett Waters. I've been in Silicon Valley my entire life, immersed in the world of startups, innovation, and venture capital. I also teach entrepreneurship at Stanford University. And one of the things that I always teach my students is that great entrepreneurs are always selling. So I should mention, I have a new book out and it's available on Amazon now. So as I mentioned, I've been in Silicon Valley my entire life. And when I feel like having tacos in Palo Alto with a great lawyer, I always call up Louis Lowe. Morning, Louis.
Good morning, Brett, and thanks for putting together another episode of this series.
And Louis, give us the brief background on yourself.
I grew up in the shadows of Silicon Valley, left for 15 years and came back in 2005. And I eat, breathe, and sleep startups and investors. And I help startups get formed, get financed, help them scale for growth, and have an awesome exit. We also help emerging fund managers create new investment platforms, and we have fun doing it. I sit about a mile from Stanford campus on University Avenue. And that's where you'll find me, Brett.
Yeah. Well, either there or Sancho's Taqueria.
Or Sancho's.
Yeah. Also joining us to get the East Coast perspective is Julie. Morning, Julie.
Morning.
Or afternoon for you, sorry.
It's okay. I'm happy to adapt. Thank you very much for having me.
Brief background on yourself.
Grew up in France. I am actually from Lyon. If you like great food and great wine, that's where you can find it.
Yeah.
I've been with Foley & Lerner for about 10 years now. I do venture capital, private equity, and mostly life sciences and tech by virtue of being here in Boston.
Yeah.
That's about it.
Awesome. So, Louis and Julie, it's hard to believe that a year ago, most of us had never heard of ChatGPT. And now it seems to have completely changed the world. And also a year ago, we were, kind of still in the good rock and roll times of the venture capital world of the last few years. And today, as we sit here in December 2023, it's a little different landscape. Everything kind of feels a little different right now. So, Louis, how would you characterize the landscape today?
Well, I'm going to just take us back, Brett, to I think the environment that most funds and startups have been in operating in for the last 15 years, and it's been the time of easy money.
Easy money.
Easy money. There's a song with that name. Yeah. And beginning in early 2022, the Fed started racking up interest rates, which fundamentally changed the cost of capital. And we saw that Tina was no longer the star of the dance. For the last 10 years, you couldn't get a return in debt securities. So Tina, there is no alternative. Tina was equities. And so there was a golden boom in venture capital that really culminated in the most bull market of bull markets that we saw in late 20 through the end of 2021. When we saw valuations and new funds being raised like we've never seen before, far beyond what we saw in the dot-com era. So 2022 was the year of steadily rising interest rates, and the rooster came home to roost in 23 as venture firms really had to pull back. And we've seen a real decline in the number of new transactions and the amount of capital that's been deployed into venture capital, whether it's tech or life sciences, whether you're in Silicon Valley or in Boston. But we also saw, some bright spots. One of those bright spots is that, Silicon Valley and Boston truly are the centers of where venture capital remains. Number two, there still is plenty of capital, dry powder, that sits within venture capital and private equity funds to invest. So there's a lot to be optimistic about, but it's certainly been a rough time in 2023.
And Julie, how does the landscape look different to you than it did a year ago? Or does it look different? Does it look the same?
I agree with Louis. We were having a chat yesterday, and I was saying, Louis, whatever I say is going to sound very grim. And he said, no, we can talk about how grim it's been, but let's just focus on how great things will be. And I do think that we have a lot of good reasons to be optimistic about the future. So the deal flow has slowed down, but I think that just gave people a good opportunity to reflect and be a bit more thoughtful about the deals that they enter into. And so in 2021, things were crazy, not huge deals, but a crazy number of deals. And now we're seeing fewer deals, but much higher deal values, because people who are able to get that money in want to maximize that ticket and want to make sure that they get as much bang for their buck as possible. So I'm very confident that things are going to get back to normal and just normalize a bit. They will have a different approach to the way in which deals are being conducted. And also, I think it gave the opportunity for other markets other than Silicon Valley or Boston to rise, like Atlanta and Salt Lake City has just boomed. And I think that the slowdown has allowed these markets to also grow.
Yeah. And that actually brings up an interesting point, which is, I remember when my VC friends would all say that they would never invest in a startup that, wasn't within about a 15-mile radius of their office, because they wanted to be able to drive over there anytime and check up on them. And it's amazing to me how that principle seems to have completely disappeared. You see all kinds of cross-border investment and out of the region investment. And as Julie said, a lot of secondary and tertiary centers of capital today that you didn't see 20 years ago. Louis, have you've seen a lot of this, yes?
It's funny, Brett. Last night, Silicon Valley Bank's Global Gateway Group hosted their annual Christmas party, and this is the group with an SVB that goes outside the United States and serves startups and venture funds outside the United States. And I was shocked to see an old friend of mine who I'll protect the guilty by not saying his name. And I said to him, hey, I've seen you investing in a lot in Latin America. Why is that? And he said, Louis, prices are really good down there, and I like to travel, it turns out.
Right. All right.
So Latin America has seen a tech boom like we've never seen before in the last 6-7 years. And it's not just SoftBank, but funds like Riverwood, Monashese, Redpoint, and I could go on and on, have discovered this great market that is ripe for disruption.
Yeah, I always say that we've entered kind of a place agnostic era, in the sense that it matters less today the place that you're in than ever before. Zuckerberg dropped out of Harvard and moved from Cambridge to Silicon Valley because back then, if you wanted to have a tech startup, you kind of had to be here. But I think today he might make a very different decision than he did then.
What I will say to that, though, and what I've noticed, especially in the last year or so, in the post-COVID era, those memes that you see on Instagram or TikTok, and it's 2020. Everybody, stay home, work from home. This is great. And then 2021, we realized this was the best thing for our company ever. Everybody stay home. And then 2022, oh, sorry, guys, we realized that actually staying from home is not great, and you're going to have to come back to the office. I get the sense a little bit like this with investors. And so maybe, they had this epiphany that, yes, you don't really need to be in the city if you're going to invest in a company, a specific city or in a country, But then as time has moved on, you still kind of miss this personal relationship that you have with people. And so now in this post-COVID era, I think people are willing and want to travel and have this personal connection more than ever before. So I have a feeling that maybe there's no longer a restriction on geography for investments, but there is definitely this push to bring back the personal relationship and the face-to-face meetings and the in-person board meetings more than even what I saw before.
Yeah, I think that's right. And I think that, when COVID first hit and we were all suddenly doing business on Zoom, we were like, hey, this works okay on Zoom. And now we've kind of got, after 2 or 3 years of that, we've kind of got clarity on what things do work fine on Zoom and what things, will just never be the same on Zoom, right? So to our audience, let me say that we'd love to get your questions. And if you don't see the little chat box by the live stream, then switch over to YouTube. Just click right in the top there. It'll switch over to YouTube. And then you'll see the chat box if you want to participate. If you want to just simply watch and not participate, that's okay too. And Julie, Andre in chat points out that Lyon not only has good food, also has great architecture.
Thank you. It's actually the most beautiful city in the world, and I don't want to offend anyone on this chat, but that's just a fact.
Yep. But that's just a fact. So let me ask you guys another question. So to me, one of the things, in terms of the headlines for 2023, one of the headlines from 2023 is that governance matters, that the FTX debacle was an example of just complete lack of governance, right? I mean, how did Sandhill Road investors put hundreds of millions of dollars into a company that had no board of directors? And, and then the OpenAI thing last month also was kind of a governance cluster. And so I'm curious whether the two of you have any kind of observations about that, my experience is that for the most part, seed level investors don't really care about board seats because at the seed level, you just kind of want the entrepreneur to go. But, once you start getting into 7 and 8 figures worth of investment, institutional investment, then you kind of want a formalized board and a formal and a seat on that board. So I'm just kind of curious, as the deals that you guys have seen in 2023, is there any more emphasis on governance structure?
Julie, I'm happy for you to start off, or I can kick off.
Sure. So the one trend that I've seen, so first of all, when you come to a law firm, you come to us, governance is we're going to set the record straight very quickly as to what needs to get done, how things need to look in order for you to raise funds, and so on and so forth. With that said, the one trend I've seen is that people are using safes more than ever, and lawyers a lot less for these early stage raises. And they can Google how to use a safe, and it is very easy. So this is not me, sending out a plug to use lawyers the second you try to raise $1. I do like the safe, and I like its goal. With that said, governance has been set aside, and we've been doing a whole lot more cleanup than ever before. And so perhaps companies have been stretching that a little more, and maybe going into the seed, doing a safe round as a seed, trying to just Google their way into how to raise funds and how to run the company. And I think engaging lawyers has been left to a later stage, which again, if that works for you, that's fine. But I think that's also part of the issue, that you're just setting bad corporate governance methods very early on and just getting into bad habits. So that's one of the trends I've been seeing.
Yeah. So I think I would certainly concur with that as an observation that, that years ago, even a seed financing would have, a law firm representing both sides. And today, safes frequently happen without counsel. And as you said, Julie, it's kind of one of the advantages of a safe. But that also means you can create all kinds of compliance issues to be cleaned up later. Yeah. Louis?
When we act for companies or investors that are raising significant amounts of capital on a safe, I think there are ways to invest safely, like with an extended side letter with a voting agreement that sets up a board. And I want to go back to the comment about OpenAI, and there's been a movement over the last 20 years for investors and companies to consider goals far beyond just making a profit. And I think artificial intelligence is a great example because of the great power that this technology has to change the way we live, work, and play. The fourth industrial revolution that is the namesake of Brett's awesome Zoom accelerator. So we've seen a number of companies set themselves up with a trust, a long-term trust that has the right to appoint a majority of the board seats, and that the terms of the trust are such that the company is and the directors that it appoints are required to take into account non-profit factors. And in fact, in the case of some of these companies, and I won't speak about any particular company in case of there's a conflict of interest, but there are companies that are not allowed to look at profit at all, and they're only supposed to be looking for the long-term good of society. And that's really where we get into a tough situation. And I think the lesson of OpenAI for me, Brett, has been not to confuse control with power, or conspiracy with competence. Because I think in both cases, those that thought that they had power failed to realize that they didn't. And those that were operating a conspiracy perhaps lacked competence.
Right.
And
I doubt
full circle.
I doubt that Satya will anytime soon invest $10 billion in something and find out that he has absolutely no board rights or control at all.
Well, again, back to my point, he did have control because within a matter of days, everything was back exactly as he wanted it. In fact, those people who were on the board looking out for the long-term good of the population were replaced by people that were pure capitalists.
Yeah. I say that Satya put on a master class over that weekend.
Yes,
it was amazing. He swooped in and scooped up all the chips and flew out.
Anyway. I want to just mention one thing that just surprised me also the other night, and it was the first time it happened, at least the first time somebody was as open as they were to me, and I hope none of my existing or that the specific client is watching this, but so LLC agreements, just for example, are negotiated very carefully. The control rights are negotiated very carefully. They're not all the same. It's not like a Delaware corporation's bylaws that really all say the same thing. But this client was asking me questions via text message and saying, oh, who has the right to do this? Who has the right to approve these things? And I was answering his questions, and he says, okay, much more helpful than ChatGPT. And so basically, before coming to me, he had been asking ChatGPT, oh, who has the right to approve these things in a Delaware LLC? And they were just giving them, the great ChatGPT answers that ChatGPT does so well. And so I think maybe that's just something that's misleading. People don't know what they don't know, and they assume wrongly that ChatGPT will give the right answer to these questions, which are not just cookie cutter.
Right. So Franklin asks a question in chat. He says, Liquid AI and a few of the other ChatGPT 4 startups are taking down Series A new money, $200 million plus. How can a deal like that possibly be structured? Multiple tranches? So I guess what Franklin's asking is, on very large investments like that, are they structured as multiple tranches? I think that is his question.
I'm happy to take this one, and please jump in, Julie. But when we hosted TED AI a couple of months ago, Deep Nashar, who's now an MD at General Catalyst, got this question, and he gave a brilliant answer, which is that investors invest based on one of two factors: either it's hope or it's reality. And in the Series A context, we do not yet have product market fit. Product market fit is when you've got $10 million of contracted annual recurring revenue, and anything up until then is good fortune, good signs, traction, but it's not product market fit. And so anything that's getting a $200 million valuation at Series A is being invested on, not on reality, but on hope. And that means
I think in Franklin's question, it's not a $200 million valuation. I think he's saying $200 million in new money going in at a Series A, which would be a very large Series A.
Yes, and it means that it's being invested on based on hope that there's a rock star founder who's done this before, and who commands that kind of trust and respect, and that there's probably a group of VCs that have put this syndicate together that they all trust each other to make sure that they're going to bring this forward. But you referenced this in one of your missives, Brett, that the age of farmed startups might be over, where we see large VC fundings of 200 million or more that happen. Maybe a word from you on that.
Yeah, well, first of all, I want to give credit to Sam Lessin of Slow Ventures. That's where he came up with the term factory farmed unicorns, meaning that we've kind of gone through this period where the Sand Hill Road folks have picked a winner in what they believe to be a winner in the category, and just plowed money into that company round after round, right from the seed all the way through a Series E through hopefully an IPO. So Sam calls those factory farmed unicorns, and he says that the era of factory farmed unicorns is over.
And I agree with that. These 200 million, these very large AI funding rounds, I think, have subsided. I think the market's turned. I agree with Sam Lessin that the age of easy money is over, where we shouldn't be seeing this. I haven't seen these deals being tranched. I've seen them coming in all at once, maybe with a little bit of an extra pocket for a subsequent closing in the next 90 days. So maybe it's 180 million at the first closing, and then 20 million in case they have strategic investors they want to bring in who could move the needle for them in terms of channel partnerships or customer growth. But I think 2023 is going to be a reckoning for all of these AI companies, because if they can't get to 10 million of revenue, it's going to be real hard to get the next tranche of money.
I'm seeing a lot of tranche deals, especially in the healthcare space, where bird in the hand is great, and so people are essentially buying an option, and the second tranche is all, and it's a lot of the times it's 50-50, or even a smaller first tranche, with the second tranche being subject to FDA approval being obtained or some successful clinical trial. So I'm seeing that a lot still there, especially when you have these large ticket sizes.
Right. So sort of conditional tranches.
That's right.
This tranche will come.
That's right.
Once you hit this milestone.
A bit of a mix between hope, as in you're going into this transaction and signing the dotted line and saying, I will commit to putting in this amount of money, but based on reality, where you really have to hit specific targeted milestones in order for your obligation to kick in.
And that's a great difference in investing between tech and life sciences. Historically, life sciences, which is so outcome dependent on a phase 1, 2, or 3 clinical test, has tranched investing. But we have seen it in tech, more and more during the slowdown of the last 2 years. I still would say it's the exception to the rule rather than the rule itself.
And then Johnny asks about, are you seeing any movement in VCs toward funding more capital intensive businesses?
Louis, I'll let you give it a shot.
I have not seen that, is the short answer.
I think, Johnny, if anything, it's probably sliding the other way a little bit right now. That kind of capital-light businesses are being celebrated right now because the cost of capital today is just dramatically higher than it was 2 or 3 years ago.
I would say the exception there is obviously corporate venture, and so I think I saw a recent semiconductor new startup that raised a very large round from a large Asian handheld producer here in California. So there are exceptions, and I think the CHIPS Act and the Inflation Reduction Act are incentivizing those large transactions.
Excellent point. Right. The CHIPS Act and the IRA both have pretty substantial incentives in them that might cause somebody to pursue a capital intensive business who wouldn't pursue it without those government programs. That's an excellent point, Louis. Let's see. So what else we want to talk about here, guys? So one of my favorite topics with regard to seed stage investing is safes versus convertible notes. And I know, Louis, you and I have talked before about how the whole idea with the safe was supposed to be that it was a lightweight document. But Louis, you said you've often seen safe deals done where they load up all kinds of stuff into a side letter, and so it's no longer really a lightweight document.
Exactly. So if anybody's investing just on the safe that's downloaded from Y Combinator, that's probably a friend or a family member, an operator collective. It's probably a check for not more than $25,000 or $50,000. But as soon as you get into a $1 million round, if you're an entrepreneur, you should expect that the investor is going to hit you with a side letter that might be 5 or 6 pages in length, and it's going to have some questions about how the company was formed. It's going to ask you a little bit about your vesting of your own equity, and it's going to have some potentially some governance protections for the investor, whether it's a board seat or information rights or other things. Same with the convertible note. The safe continues to be, in my experience on the West Coast. Curious, Julie, if you've seen a change, but I'm still seeing that the safe is the preferred vehicle for bridge financing and early stage financing, and convertible notes I'm still only seeing in the context of a distressed situation where a company's running out of money and it needs to get bridged to either a next round or an exit. Julie, tell me, are you seeing anything different in Boston?
I'll say I think people maybe are a little more conservative than on the East Coast, because
you don't say.
Come on. Well, not me, obviously, but in general. I'm seeing convertible notes mostly for bridge financing still, and people like the comfort of being in a debt position. For early stage, though, I will say safes have become the default, even here.
And Julie, if a fund came to you, if a seed fund came to you and said, should we structure our investments as seed investments as safes or convertible notes? How would you answer that from the investor perspective? Which do you prefer?
Well, I would say it depends. Obviously. There's no one size fits all. I would just try to understand. I would want to understand more about the company. Do we have any benefit to be in a debt position? What kind of fundraising has the company done before? Have they used a safe before? Have they used a note before? What do others want to do? Do we have more, are there any other more conservative investors in this syndicate? Are you by yourself? Are we trying to go quick? Do we want any reps and warranties? One of my pet peeves is using the safe and then starting to mark it up. If I get a marked up safe that doesn't look exactly like the Y Combinator safe, I'm okay with a side letter, but the safe itself drives me nuts. So, unless you're prepared to keep it very simple and use the safe for the very purpose for which it was created, then potentially I'll consider a note, again, if the context makes sense.
Brett, I think the one of the big differences that both entrepreneurs and investors fail to realize when they're making this decision about safe versus note is the safe is constructed to be a post-money instrument. It converts on a cap that is post-money, and a convertible note converts on a pre-money cap. And so you really need to understand in a pro forma with a startup lawyer who knows what they're doing and can show it to you what things will look like when you convert. That's my advice. And to all those startup entrepreneurs out there who have been raising on notes for a long time, please check the maturity date. We're seeing a lot of these maturity dates come up, and they need to be amended and extended. Otherwise, one of these holders could walk into your company and take it over tomorrow.
Yeah, I actually had that happen to me once. I raised around on convertible notes, and the 2 years came and went, and we hadn't raised an equity round, a price round. And it wasn't really clear what was supposed to happen. In other words, the notes were just simply due and payable, right? Principal plus accrued interest. But we didn't have any way to pay them. So, luckily, I simply, called all the investors and proposed that we roll them over to equity on a particular deal, and they all accepted. But it was a good lesson in the fact that the expectation was that within 2 years we'd raise a Series A and the convertible notes would all convert. And then when that didn't happen, it wasn't exactly clear what the expectations were.
Yeah, and it is a real concern if you don't have the cash to pay off a disgruntled note holder.
Yeah,
which is an issue
right.
you have with the safe. Yeah.
Right. So
Brett, I would also say
yeah.
the following. A lot of investors right now are saying, hey, I hear you that you'd like a safe, but I'd really like to make sure the governance is properly done now. So we're going to invest on a Series Seed equity basis with a priced round, very low valuation. Investor takes a board seat, takes a lot of rights. And I think the pendulum has really swung from let's have super voting founder stock to let's have Series Seed preferred equity rounds with low valuations and lots of governance.
Yeah. I have one last question on the convertible note versus safe thing. So, so my understanding is that debt is always senior to equity in the case of liquidation, right? But a safe isn't that. So where does a safe end up in the liquidation stack? In anywhere?
Julie, you want to take it?
You are intended to be treated as a non-participating preferred shareholder.
Excellent answer. Thank you.
So you're going to get your money before the common,
right?
Up to your cap of 2x usually, which is set forth in the safe.
Even if it hasn't converted.
Correct.
Interesting. Yeah, interesting.
It's a claim against the company that's ahead of the equity.
Yeah. Got it. Okay. So you still have seniority in the liquidation stack over common equity.
Over common, but of course not over the whatever debt or whatever's owed to employees or the top of the pile of the government.
Right. Okay, so let's talk a little about exits. So, the entire reason that an investor buys equity in a company is with the expectation that there will be a liquidity exit. In other words, the company will either have an IPO or it'll get acquired by Google for $1 billion. And right now the IPO window is not exactly wide open. And we saw, I remember around the 2008 kind of time frame, we saw a lot of aqui-hire kinds of deals. In other words, companies being sold because they just kind of stalled out. But there was value there for somebody to at least, buy the talent, hire the talent. And that gave some sort of a marginal exit available to investors. But what are you seeing right now, Louis?
Well, here's the thing. Politics aside, the current administration put in place a policy that they wanted to crack down on mergers and acquisitions by the large tech players. That their view, like it or not, was that this was stifling innovation and competition. And so the big buyers, Apple, Amazon, Microsoft, Google, et cetera, have really been on the sidelines. And while there have been one or two transactions that each of those have been able to push through the Federal Trade Commission and the Department of Justice, they've really been told, hey, you need to be on the sidelines. We will sue you. We will block. And whether or not that position is right or not, it's put a real chilling effect into the market for M&A, because the big tech buyers can't play. Secondarily, you're in an environment where the other buyers, the financial buyers, the private equity firms, are in this environment where interest rates are higher and the cost of capital is higher. Growth has slowed down, and so valuations are way down. And so the combination of these factors, Brett, has been a huge fall off in the volumes of M&A transactions in the last few years, but especially in 2023. Now, I think that's going to change in 2024 because the new venture financing is now called an acqui-hire. The new venture financing is this. VC says portfolio company A is going to do okay, but it's not hitting its numbers. Portfolio company B is not going to make it. So portfolio company A, you acquire B, take all its money in the bank, take all its technology, take all its sales. You get to declare that you're up 40%. So you're now rule of 40 compliant. And, in terms of the burn rate, we'll cut employees or whatever we have to do to make sure that the burn rate is static, and that we have a good story here for portfolio company A. And then the good news for portfolio company B is they can say they had an exit. Of course, they don't say that it was a belly flop. This is the art of the belly flop. I think it's going to be venture financing 2024 is my prediction. But Julie, what do you think?
To be perfectly honest with you, I got distracted for a second. I don't remember what the question was, but I do agree with everything that you said. And I'm seeing just a lot of creativity with investors merging their portfolio companies, coming up with very creative solutions to issues that they potentially didn't have before. One of the other unfortunate sides also of what's been happening in 2023 is I've never done as much bankruptcy planning or pre-bankruptcy planning as I have before. And so everything you're doing is also taking into consideration, and I'm sorry, this is probably off track from what you asked, but I think an important point, especially as you're going into a venture financing or any M&A transaction, is what would happen in the case of a bankruptcy, and if there is a belly flop, what happens then? We didn't really worry about that in 2020 and 2021, 2022. This year has been one of those, years where you have a lot of learning experiences.
So, back to your predictions, Brett, on what exits look like in 24, in addition to, this art of the belly flop and acquire, pickup that I expect that we'll see. I do think that, private equity is going to be more aggressive in the coming year. They've got lots of dry powder to deploy. I think interest rates have stabilized and might even drop a little bit. And I think, there's some pent up demand. So I think it's going to be a better year in 2024 for exits.
Excellent. So speaking of 2024, I'd like to wrap this up with the final question for each of you. So Julie and Louis, you have each a lot of experience representing both investors and also founders in startup financing transactions. So Louis, I'm going to ask you what advice you would give to entrepreneurs who are looking to fundraise in 2024. And Julie, I'm going to ask you what advice you would give to startup investors with regard to 2024. Who wants to go first?
I'll take the entrepreneur question, and really, I think the my advice is always to hit hard and to go fast. So as you're beginning the process, it's making sure you have a really good pitch deck that has a 3-year operating model in it, which is going to show an investor that that the money that they give you has to take you from point A to point B, and that they can see exactly where you're going. You need to have as many meetings as you can. Zoom is still the preferred way a venture capital investor is going to want to meet you for 15 minutes. They're going to need to see your deck in advance, and then they're going to need to have 15 minutes, and then you'll get some feedback as to whether there's a fit. Once you have a term sheet, Brett, my strong advice is to go fast. And the biggest mistake I see happening is lack of preparation and failure to execute, and a process that goes on 90 days, which is every day that you don't close is a day of risk. So I'll stop there and turn it over to you, Julie.
I think that's right. Although we also say that from what I've seen, deals are just happening at a slower pace right now, and diligence tends to be a little bit longer.
A lot longer.
Mm-hmm. Yeah.
I was going to say, my advice would be the exact opposite of Louis for the investors. It's don't rush into this deal. If you have dry powder and you have money, you are king. So you don't want to rush into this. You don't need to anymore. If you have a term sheet and, hopefully you were able to negotiate a exclusivity period, which is not too hard these days, especially if you're holding the cash, then take your time, do extra due diligence. Before maybe you were happy with red flag corporate diligence. Now, maybe go a bit deeper, do technical due diligence, do financial due diligence in depth. There's no reason to rush into this right now. So that would be my advice. Just, take your time.
Yeah. So I think that probably sums up the current dynamic pretty well, which is that it's shifted from being a market that was very much an entrepreneur's market to being a market that is much more the investor's market. So,
Absolutely.
yeah, and so that means that time, as an investor, time is on your side now. And as an entrepreneur, you want to close the deal right away with the minimum amount of due diligence, but you're less likely to be able to get that today than you would have 2 years ago.
But Brett, just like when you sell your house in Silicon Valley, you get the inspections done in advance. So there is no reason that if you're an entrepreneur, you shouldn't have a sparkling clean data room and cap table ready to go with whatever patent applications already uploaded, your equity already uploaded, so that you're minimizing this desire to go slow, and you're not feeding the beast with reasons to slow down.
Right.
And I agree with that. If there's one thing, if I have one pet peeve in this process, it is when these companies clearly need the funds. You have an investor, you have a term sheet, they are spending so much time doing their due diligence. They want to meet you, they want to meet your management team. Make it a priority, make them feel special. Don't, make sure you have a team worrying about operations. You're the CEO right now. Your goal should be to fundraise. And if the investor wants to have a call on this day at this time, make it your priority. If they want to talk to you 2 hours on the weekend, make it your priority. You want to rush and you want to make sure that the investor doesn't get distracted and wants to close as quickly as possible. That would be your goal.
Yeah. That is excellent, sage advice. Big thanks to you both. This has been a great conversation, and
Thank you.
just to end it on a positive note. While it's definitely a little bit of a challenging environment right now, but I think the opportunities that are out there right now are just extraordinary. I always say that through my career, there was usually kind of one wave at a time, right? There was the semiconductor wave, and then there was the personal computer wave, then there was the internet wave, and then there was the mobile social wave. And each one of those lasted, 10, 12 years, and then we were on to whatever was next. Right now, there are, 4 or 5 or 6, really salient waves right now. You got the AI thing, you got medical technology, you got autonomous vehicles. So I do think that
Climate change.
Climate's a pretty big one, right?
Space travel.
Ag tech. I'm actually pretty excited about ag tech.
Yeah.
There's a lot of really interesting stuff going on in ag tech right now. And ag tech is kind of at the intersection of 2 mega trends, right? One is that we're burning the planet to death. And the second is that agriculture turns out to be one of the contributors to the fact that we're burning the planet to death. And so at the intersection of those 2 things is an opportunity to make a huge difference. So while it's true that the capital markets are a little more challenged right now than they have been in recent years, I think the opportunities ahead are extraordinary. So thanks very much to our audience for joining, and thanks again to Louis and Julie. It's been a great conversation.
Thanks.
Thank you, Brett. Thanks, Julie.